a lot of businesses, a lot of consumers are fearful, and they're going to be looking for better, cheaper, faster, more productive, more creative in terms of products and services. So we have high hopes that when the new leadership shows itself, and typically if we are in a correction or a bear market, towards the end is when we see new leadership. I remember very clearly in 08-09, the market did not bottom until March of 09, and our strategies started outperforming in November of 08. This is what typically happens as the market looks to the new leaders.
Consumers are anxious, and that's when the real opportunities arise. When wallets tighten and uncertainty looms, innovation thrives. History teaches us that market corrections don't just eliminate the weak, they give rise to new giants. Take 2008, for example. The crisis wiped out complacent players, but it also paved the way for fresh leaders to emerge months before the market hit its bottom. We're seeing a similar story unfold today, as fear takes hold on Main Street and the search intensifies for better, cheaper, and faster solutions that redefine industries. Cathie would recognizes this moment for what it truly is, a launchpad for the next wave of growth. She recalls how her strategies began outperforming back in late 2008, long before the market even began to recover. True leadership, she believes, shows itself before the rebound. In today's environment, with consumers demanding more for less and investors seeking direction, the next group of winners is already beginning to form. The real question isn't whether they'll emerge, but who they'll be and when. According to Cathie Wood, the future champions of the next cycle are already taking shape, from fintech disruptors to AI-powered services. For those with the patience to identify them early, the potential for reward could be nothing short of historic. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
Enjoy the video.
So here, I've seen these charts for years and years and years, but I didn't realize that we had hit from a public debt as a percent of GDP, that we had hit the peak we reached in World War II. In the 2000 timeframe, there was the thought, could we be heading in the tech and telecom bust? Could we be heading towards that level? But here we are. And, that was a crisis time, and the country really did pull together after that to get the debt as a percent of GDP down. It did it in two ways. More control over government spending. Of course, we weren't in the war anymore, so that was a big source. But also on the GDP side, rapid growth. Post-World War II, very rapid growth. Doge, we think, is an attempt to pull us out of a quagmire, it seems, in terms of government spending. It's what held the economy up, or real GDP up, along with high-end consumers during the last few years. But this is certainly excessive as we see it now in context. And you can even see in the 20s, in the 20s and 30s, we didn't get anywhere near this level. Another look at the budget, and you can see total outlays as a percent of GDP, around 24%. Now, what is not clear from this chart, but I do know, having studied this, is that receipts tend to top out in the 17 to 20% range. If the government tries to tax people any higher, they figure out ways around it. They either stop working, or they do a lot more under the table. I don't know what it is exactly, but that receipts as a percent of GDP rarely goes above 20%. So this deficit is structural. And I do believe that with Doge and with more rapid GDP growth, we could move back into the period like the 90s. That was the last time we saw a surplus, and it was under President Bill Clinton and Newt Gingrich, who was a powerhouse in Congress, and they worked together to get that done. We do not have as much of a bipartisan situation right now, so we'll probably have to do more on the rapid GDP growth side of things. And if we're right, if deregulation, tax cuts, lower interest rates are what we're going to see as the government has more degrees of freedom during negative GDP quarters, then I do think we'll see much more rapid growth in the months ahead, months and years ahead, I should say. Onto monetary policy. Here I've presented this a number of times. It does seem like CPI, which is in the green there, is kind of stuck in that 2 to 3% range. Now, there are other measures of inflation out there that are saying something different. There's a measure called Trueflation, and we'll have it for you in the next, I think we're going to subscribe to their service, so we'll have it for you in the next package or in the next In the Know. It is saying that inflation is down to 1.3%. And this is a real-time measure of, I don't know, I used to say millions of products and services, but I think it's more like tens of thousands or thousands, but real-time, constant monitoring. And it peaked at 11% just about the time that the CPI peaked around 9%. It is now down to 1.35%. And as you may also notice, the oil price seems to be under severe pressure because Saudi Arabia is opening the floodgates. Purportedly, it is railing against Kazakhstan and Iraq overproducing and is just opening the spigot. There could be other reasons. Part of the negotiating out there, President Trump, I think, is with Saudi ministers this weekend, maybe even MBS himself. And there may be, and as he's been very vocal about getting oil prices down. So that may be part of what's going on here as well. Of course, the third variable is weakness in the economy. So all of those accumulating, which is going to take that trueflation measure of inflation down even further.
America's debt-to-GDP ratio has reached levels not seen since World War II, but this time we lack the post-war boom to help us recover. While the 1990s were marked by surpluses driven by growth and bipartisanship, today's polarized political climate leaves us leaning on unstable solutions like Dogecoin and hoping tax cuts will magically stimulate the economy. Inflation paints a confusing picture. Oil prices are dropping, but taxpayers are reaching their breaking point. The harsh reality is we are navigating uncharted waters with no clear plan. Can innovation outpace this spiraling debt, or are we destined to repeat history? Commodities have plummeted to 2000s era levels, while gold continues to demonstrate its enduring purchasing power. Treasury yields have dropped below 4%, supported by $250 billion in stablecoins, and this is just the beginning. Bitcoin, though struggling against gold, is still following its long-term trend. Meanwhile, Saudi Arabia's oil flood is altering the landscape, and the 40-year downward trend in yields has been broken. According to Cathie, we are now in unfamiliar territory, where tech-driven deflation could fundamentally change the rules of the game. Traditional market strategies may no longer apply in this new environment. Let's dive into more insights from the interview.
Now we're on to more market indicators. So Bloomberg's Commodity Price Index, we did this chart earlier this week. I think the Bloomberg Commodity Index has dropped back to 100, and probably will continue to go down if our economy is as weak as we think it is. But as I always like to highlight, the Bloomberg Commodity Price Index is today where it was in the early 2000s, in the early 90s, in the early 80s, which from an inflation concern point of view helps put where we are in perspective. The real inflation was in the early 2000s. For some reason, it didn't get through to the broad-based indicators the way it did to commodity prices. But there is much less inflation now. And now we've got oil prices, the most visible, cracking on us. Here, metals to gold, the purchasing power of gold has continued to go up, as you see in the purple line. So metals relative to gold. When this line is going down, the purchasing power of gold is going up. Gold can purchase more in the way of metals at a given price. Now, this chart doesn't show what has happened today. The 10-year Treasury bond yield did drop below 4%. If we're right on what's going on here, the 10-year Treasury bond yield probably will continue to come down. I know a lot of people speak about China and other countries disgorging our Treasury securities, and from a supply-demand point of view, that is happening, and it is a lack of demand relative to supply showing up. But there is a bit of a flight to safety going on right now. And there's also another phenomenon. I don't know how much it would have an impact on this, but the stable coin movement, those are backed by Treasury securities. And while they're Treasury bills, I'm sure there are ripple effects throughout the yield curve. So the stablecoins are now up to 250 billion, and we expect them to go to 1.4 trillion in the next 5 years. So we would expect the pressure on interest rates in the near term here, certainly because of the economy, to be down, to go down. Bitcoin to gold. Gold has had a good run against Bitcoin. Bitcoin did very well relative to gold in 23 and 24, but not so this year. Nonetheless, we do think over time Bitcoin will appreciate relative to gold. And as you can see, it has not broken the uptrend line. Here is the S&P price relative to gold. This is an indicator that Charles Gov of GovCal is monitoring, and he would not be surprised to see the S&P fall as it did in the 70s relative to gold. We would be surprised to see that, especially if we're right on all of the productivity and pent-up demand that fiscal and monetary stimulus should unleash during the years ahead, and the productivity gains associated with it. On the other hand, he would have expected this metric to go down as well, but it is not. The S&P is holding up relative to oil. Oil, of course, is capitulating recently, as I mentioned, because of Saudi Arabia's recent decision. And just a few more charts here. 10-year Treasury yield, we did break the downtrend, and that was a 40-year downtrend. probably in COVID got to too low of a level, and we would not be surprised to be in a range now for the next few years, 2.5% to 5% range perhaps. But if we see more deflation thanks to the new technologies that are evolving, we wouldn't be surprised to see it settle a little lower than 2.5%. But clearly the burden of proof is.
In times of economic uncertainty, innovation often emerges from the challenges, much like it did during the 2008 financial crisis. The fear and tightening of wallets that grip consumers can spark disruptive ideas that reshape industries. Leaders who recognize these opportunities before the market recovers, like Cathie Wood, understand that adversity fosters innovation. Her strategies began to outperform even before the market rebounded in late 2008, showing that true leadership often emerges ahead of a recovery. Today, we are witnessing a similar wave of transformation. The increasing adoption of cryptocurrencies and the rise of stablecoins are changing how we think about money, echoing the rise of tech disruptors in past economic cycles. Charles Hoskinson, the founder of Cardano, predicts that Bitcoin could reach $250,000 this year, fueled by geopolitical instability and the growing shift toward crypto solutions in global trade. Additionally, the adoption of stablecoins by tech giants like Apple and Amazon, once legislation is passed, could mark a major turning point for the financial sector. With the U.S. facing rising debt and political gridlock, traditional economic strategies are proving less effective. However, as with past downturns, it may be the innovative thinkers and emerging technologies that offer solutions to navigating these uncertain times. The next generation of industry leaders is already forming, and we could see crypto and tech-driven solutions redefine how we perceive wealth and value. As we wrap up, do you think Bitcoin will replace gold as the ultimate hedge against fiat currency collapse? Share your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.